just turn to the other side, which is the lessors. All right, the lessor basically what we call here is based on International Accounting Standard number 17 or even Chinese Accounting Standard as well. We call this as direct financing lease. Just like we support the lessee, right? Look like the lessee borrowing money from us and buy the asset. Just think it like this. They get the money from us and they buy the asset. But in fact, the money didn't go to the lessee. All right. Okay, so we call this as direct financing lease, not self-type lease. I'm going to talk about this later on for self-type lease. So basically, things about if we do financing, just like we loan the money, isn't it? So you're going to have loan receivable. Okay, and we sacrifice the asset. So on the other hand, if we treat the contract as an operating lease, of course you got the rental revenue. Think about operating lease on the lessee side. They have rent expense. All right. So if the both contract are the same thing, rent expense and rent on our side is going to be rent revenue. That's it. Very simple for OL. But for FL up there, of course, just like we give money to them, so we're going to have receivables, loans, receivables. All right. Of course, but if we go to the other side of the world, SFS, Statement of Financial Accounting Standard number 13, which is in USA. They follow this accounting standard. They're gonna have, we call like capital lease. But capital lease break into two parts right here, these two bullets. Self-type lease or direct finance lease. This one, same thing like IAS number 17. But this one, what that's supposed to mean? When they say self-type lease, it means what? It looks like lessor sells the asset to the lessee. You're going to have the profit right here. Underline this profit. So it means what? You're going to have the cost of the asset and you're going to have the price that you charge from the lessee. The difference between the price you charge and the cost of the asset we call as the profit. So it looks like we make a sales. Of course, things about when you sell inventory, when you learn with Dr. Pimsley. We have sales versus cost of goods sold. So right, if you identify as a self-type lease, of course, you're going to have the profit, which is the difference between sales and cost of goods sold. Got it? All right, so let's go with the basic thing first. Go for the direct financing lease. So this is the difference between these two things. All right, I'm going to jump into the examples. Now, you can go back and read it by yourself. Same things happen. I just copy and paste. Copy from the lessee type to the lessor type. If you read the line, the Danny Note lease some music, same thing. Leasing term, 3 years. Lease payment every year is about 21.6, which is include 1,000 security costs. All right, made every end of the year. The fair value, which is the present value of the future value, which is 50,000. Useful 3 years, no salvage value. All right, and of course the implied interest rate is going to be 10%. Okay. So rather than borrowing 12%, they go for lease contract and get less percentage of the borrowing. That's why some people ask me after class for break, like, Ajahn, do we have to concerns about this 12%? I would say you don't have to worry about this because this 10% is related to your calculation. Okay. Well, let's see what's happened. Same table from previous slide, lessee slide. Look what's happened. You got receivable. You got an asset. Because the fair value of the asset is 50,000, right? The difference between lease receivable and the asset we call unearned interest. The reason why you call unearned because it's the interest that you're going to get from the lessee in the next 3 years. Isn't it? That's why you call interest that you cannot earn, which is as a liabilities. All right, I'm gonna move this one into the visualization so you get it better pictures. Okay, so from the amortization table, which is right here, use the same table here and just record. Alright, so basically what happened on January the 1st if you do buy the single shot right here. Total contract, this is what you're gonna get from the whole contract, right? So that's why you debit roll receivable for 63,318. And of course, the fair value of the asset as we just mentioned before. You can credit the asset at 50,000. So the difference here turns to be unearned interest. All right, for 1. See what happened? Same number, right? I just break it down 3 parts over here. So this is on the 1st of January. Okay. So what next? Once you get cash on December 31st of year 1, you get cash first, say, I got cash 1,000 in form of executory cost, right? Just like that. And you can have as other revenue or whatsoever, all right? Or you get that from, it can be like other income here for 1,000. And what about 2106? You debit cash for 2106 and credit to loan receivable for 2106. Isn't it? Just like you get it from your receivable, just like you get money from account receivable. But one more thing that you need to do is, what happened to my unearned? The unearned here time to recognize as a interest revenue. And looking at the table, how much should I take it? For 5,000. So that's why I debit unearned interest for 5,000 and credit to interest revenue for 5,000. I just break from the compound entry into 2 entry here. And we keep redoing the same thing in the second year based on this number. Again, December 31st of year 2, you get cash, credit loan receivable, copy, paste, done. What about unearned interest? Another 3, 4, 8, 9 should be recognized. Then credit to interest revenue. And of course, if you want to recognize the maintenance fee, but sometimes for the maintenance fee, you didn't pay for the finance institutions, you pay for somebody or third party. You ask third party to maintain your things, your asset. So that's why sometimes the financial institution did not record the executory income here because you asked third party to do maintenance for you. Thinking about it, you want to lease the plane. You pay this amount to the bank, but you pay this to who? To the maintenance people, which is different person, isn't it? So I would say this one not going to happen in terms of the bank. Normally this happen to the maintenance people, just like that. So from this table, we keep doing the same thing until the end of the contract. All right, so that's going to be this scenario. But what if it's turned to be sale-type lease? See, this is direct financing. If it turned to be a sale-type lease, well, this means what? We're not going to support them, but we sell to them. We sell the product to them, to the lessor. So it means you should have sales amount and you should have cost of goods sold. All right, keep this in mind. And accounting people need to reflect what's going on. So look at the top part. Only this top part, which is different from this previous slide. Debit receivable, unearned interest, rather than credit to the asset, you credit against sales because you make a sales. Because that's sales type list. And by making a sale, you should recognize cost of goods sold of your inventory. Let's assume the cost of asset that you just made already is 35,000. So how much profit you make so far? 15,000. Right? Sale versus cost of goods sold. The rest is the same. I'm not going to touch that. All right. The difference is just only the first two journals here. Got it? That's what we call sale type list. In America, some people did like this. Sale type is mean you need to recognize the revenue as sales. And don't forget, we have cost of goods sold. All right, perpetual system. Like that. If you do periodic system, of course, this one not going to happen until at the end of the period. Got it? Okay, that's what we call for sale type list. Okay, clear? Well, if it's turned to be OL, this is what happened. What happened in terms of OL is mean what? You still got the asset in your account. You got the rent revenue. That's why the asset still with you as a lessor. That's why you got depreciation expense. Together with accumulated depreciation right here. Not only you got rent income, you also have depreciation expense. Look like you make some profit too, isn't it? Revenue and expense. So, if you are the lessor, which one you want to go for? OL or FL? Looking back what we just did for 3 slides away. You can write down the benefit. Do like this. I would suggest you to do like this. In terms of lessor, OL, FL, direct financing lease, and sale type lease. Looking at the effect of PL, what they got. Profit and loss, rent, revenue, depreciation, right? How much you got on here for rent revenue? 106. Depreciation. The net effect is about 5,000. Effect PL, isn't it? What about direct financing? You have sales. You have cost of goods sold straight away. 50K and 35K. This is what you make profit. And you do have interest revenue for about 5,000. You remember? They just copy from slide number 23. Oh, no, sorry, this is the sale type. Wrong. This is direct finance. Sale type, 50K, you make sales. Cost of goods sold 35, you make a profit so far, 15, plus interest revenue. Alright, you go back on, you can write it down, this is from slide number 23. And this is from slide number 24. So you can go back and see where I got the number from. So what about direct financing? It's from slide number 22. We have only interest revenue for 5,000. Okay. So if you are the lessors, which one you want? This is for first year, isn't it? You will say, well, Ajahn, for self-type lease, if we ignore the profit, we got 5K so as an interest revenue. Same thing like what we got for direct financing. Alright? For OL, it's just about 4,000 each of the profit. You may prefer FL. Right? You may prefer FL. For OL, this remain the same across 3 years. Is that right? About 4 each all the time. But what about this? The interest is the same? No, it's not the same. Right? In the next year, second year, how much interest you got to record?
Something like this.
How much interest revenue you record?
3,000.
3,500 approx. Last year, 1,000 something. Alright, so you want revenue steady like OL, or you want revenue to be declined like FL? Up to you. Think about it. When you structure the contract, alright, you want to save tax, do the tax minimizations, or you want to get high impact from the stock market participants. It's about your motivations. That's why learn accounting got to be down more. Why management pick this, not this? Why management like to classify investment as available for sales, not trading? Why management prefer to go for investment in associate? Why management prefer to have subsidiary, not associate? Why management go for joint ventures in type of investment? I don't want you to just to be the mechanics. Let accounting people do. If you want to be the management, think more. Before you can think like that, of course, learn all the mechanics. Otherwise, you don't know what accounting people report to you guys. Alright? So this is for the lesser's consequence. OL or FL. For the lessee consequence, of course, you got both for OL and FL. Alright? So, by doing like this, thinking about the effect of ROA, ROE, 3 types of this, which one you prefer? For ROA, OL, you still have an asset with you, right? You still got an asset with you. The asset, ROA, asset still neutral. Return not sure. Turn to FL, what happened? You write off the asset. What's gonna happen to your ROA? Up or down? Right? Because you write off the asset, give your asset to the lessee already. So you don't need to worry about the asset. Isn't it? So this is how you play with the financial statement. Play by the rules. Isn't it? Alright? What about ROE or asset turnover? Think about asset turnover. You told the formulas, sales over the asset. OL still got the asset. So turnover will be low. FL, No asset, recognize sales. If you are sales type, what happened to turnover? Alright, play with the numbers and pick your preference. Okay? Make sure you got different dimensions. Well, what about the cash flow statement? OL, operating cash flow coming in, isn't it? Because you got the rent revenue. It's coming in right here. Depreciation, non-cash, isn't it? So this is good, all your cash flow operation, right? What about this? Cash flow from interest, revenue, right? It's from the sales. What about this? Cash flow only from interest, revenue. If you are a finance institution, your cash from the interest revenue treat as a CFO. But if you are not finance institutions, interest revenue can treat as investing activities, right? But if you want to running the finance, the lease business, of course, you are supposed to be finance institutions. So basically, interest revenue classify as operating activities. But if you turn the hat into the lessee, it's another scenario. Okay? Because it can be manufacturing company leased from the finance company. It can be trading company leased from, so interest expense subject to what they ask. Alright, so I want you to keep this in mind and see what happens. Okay? There are another something for you to look at. We have this kind of thing we call sales and lease back, which is lots of companies love to do. What that's supposed to mean? When the company make the sales and then they lease back, they sells the property or the machine whatsoever to another company and lease back. What they try to do? Think first. If they make the sales, I sell the machine to you and then I lease it back from you. You know what I mean? So what happened? When they make a sale, assets go to you, right? I got cash coming in, okay, right? I can make a profit too. When I lease back, I'm going to ask you what kind of lease you're going to go for, OL or FL. You want your asset back, or you just want to rent? If you construct transaction like this, what that's supposed to mean? You de-recognize the asset in terms of leasing, right? You de-recognize your asset out. And now it's time to think about you want the asset back or not. If you want to create a higher ROA, of course, I want to construct as a hotel. Because I already de-recognize the asset and enjoy the profit. Right? I make a profit already from sales transaction. So this one is quite tricky when this comes to the real world scenario. Sales and lease back. Now it's time to think about, well, who should own the asset? If you sell and lease back, it should be OL or FL. What do you think? If you don't know accounting at all. If you think it's by law, you say when you lease back, you take it back. You still want that asset, isn't it? Otherwise, you just make a sale and then you don't want to mess with that. Right? To be honest. If you want to sell, just sell it. Don't rent it back. right? So that's why basically, if people think, oh, it should be FL, isn't it? Right? Make a sales and bring it back. So you intend to use the asset. Check 5 situations. Check 3 indicators. Isn't that right? Go and read it. Are you sure when you do the list, you're not going to comply with 5 things? Are you sure you want to avoid like this? Fight with me if you want to be an OL. Right? You got to have strong argument if you want to be an OL. Alright? Another thing that you can think of is another transaction that you can learn is what we call synthetic lease. Can you guess what that's supposed to mean? Synthetics. You can search now. What is synthetic lease stand for? It's another kind of balance sheet financing. Synthetics.
I mean, yeah. This one.
What is this? A synthetic. What did they do? It's a lease, but
Yeah.
what does it?
I don't know. It's within, at least back within a company.
They create some, they manipulate some transaction to make it look like a lease, isn't it? That's what we call synthetic. All right, but before we jump to the synthetic slide, let's take a look at sale and leaseback here. Sale and leaseback here, if you sales, of course, it's a sale transaction, but when you lease back, accounting standard number 17, we are on slide number 29. If when you lease back, we're going to treat them as finance lease if the process over the carrying amount is deferred and amortized over the lease term. It is OL is mean what? The transaction create at put the line here at fair value. Alright? And the sales price is below fair value. What that's supposed to mean? It look like you recognize loss when you make a sales. Right? You recognize loss, you suffer from loss. And of course, profit and loss recognized right away. Just like that. That's the rule when we classify. But, well, let's think. This is synthetic lease. They just create some transaction to replicate the lease, like that. To just like you replicate the lease here. Of course, look like first. Just like you want to create the rent expense in your statement, income statement. All right, but you try to create some transaction to replicate just like we're doing operating lease. But in fact, it's not. They do some criteria whatsoever, try to make it look like we try to working on operating lease. So then I can recognize that thing. Alright. Well, I just passed you I'm not gonna say test, I'm gonna say in-class exercise for you guys. It's about the lease to work for about 25 minutes. Okay, you are welcome to work as a group. We have 10 questions to go. Oh, everybody got your homework back? Right here. All right. Write your name on the papers as well. you got time to finish by 9 p.m. I need to collect it back and do some